The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
With the April 18th U.S. tax filing deadline approaching, a CoinTracker survey shows only 25% of crypto holders are prepared for tax season. As many as 40% of participants didn't know that selling crypto is subject to taxation, and roughly half were unaware that sales of NFTs fell into this category. Helping us through this maze is David Kemmerer, co-founder and CEO of CoinLedger, crypto portfolio tax reporting tracker. Hi, David. Thanks for joining us. So, is it safe to say that a lot of people who own digital assets are unaware of their tax liabilities, and what are the consequences therein?
Yeah, definitely. We see it all the time. A lot of people have just the misconception that, you're only maybe taxed on crypto when you cash out from your exchange or cash out to fiat currencies. And the reality is not the case, right? You're triggering taxable events all along the way, whether you're trading one asset for another, or whether you're earning cryptocurrencies from, the likes of staking or interest programs within CeFi or DeFi. So I think the first and foremost thing that people should do is just get a base level understanding of how crypto taxes work.
All right. So what are the common mistakes, and what advice do you have to offer people?
Yeah, so I hit on a couple of them right now. I mean, the most common mistake is lack of education, where you just don't understand the tax liabilities that you're racking up throughout the year. And so that's for folks who maybe, are earning staking rewards or generating interest, high interest on various deposits. And so then, they're not accurately tracking how much taxes they're going to owe come April 18th. And then they're left sitting with a pretty large tax bill during that time. And, then they have to do some things that they wouldn't want to. So that's the biggest one, is education.
Well, the crypto markets are down right now, so a lot of people are potentially facing the problem of having to pay a tax bill they can't afford because their crypto is no longer the same price as when it was earned or vested. Any advice for those folks?
Yeah, so unfortunately, because the tax year ends right on December 31st, 2021 for the 2021 year, there's not a ton you can do retroactively now sitting here in April. And so that's unfortunate, but you can get smarter going forward. And so always good advice is, put some aside in stablecoins if you don't want to come out of crypto totally to anticipate your tax liabilities. Use tax software or keep good records on your own so that you can have a good baseline understanding of kind of where you sit throughout the year. And then do things like strategic tax loss harvesting. So, these markets are volatile. When assets do dip, that provides a tax savings opportunity. You can realize capital losses, which reduce your total taxable income. And crypto tax software like CryptoTrader.Tax can automatically help you do that. So those are a couple of the tips that I would give folks who come to us all the time.
So, David, how do you make crypto taxes easier?
So, I mean, we think about that every single day. We've been thinking about that every day for the past 4 years. You could look at it from a couple different lenses. Easier by the software providers, right? We want to integrate with more and more protocols, blockchains, wallets, exchanges, so that no matter who comes to us, we can import any transaction and do their taxes with the click of a button. From a regulatory lens, I do think there's specific legislation that can happen that could make it much easier. Things like not treating stable coins as one-to-one the same as something like Bitcoin. Because then, using stable coins for things like payments or really anything is not triggering capital gains taxes along the way, which is very frustrating for a lot of folks and just complicates the whole thing, increases the cost of compliance. Things like a de minimis exemption, where, X amount of your first $600 of capital gains is tax-free. There's a lot that can be done. I'm not incredibly optimistic that it will be done, but the more and more people that come into the space, the more pressure it does put on regulators and politicians to pass pro-crypto things. We're already seeing that, so that's exciting.
Yeah, well, we did see that U.S. Congress claimed it could raise $28 billion from crypto investors by applying new information reporting requirements to exchanges and other parties in the latest U.S. infrastructure bill. So they do view it as a lucrative source of government revenue. I wonder if you have any more advice on NFTs as well as airdrops.
Yeah, NFTs are obviously the big one from this year. The big one that people don't realize on the NFT side is you're incurring taxes, unfortunately, when you buy an NFT, typically because most folks are buying NFTs with other cryptocurrencies like Ethereum, right? And that purchase of Ethereum for the NFT is technically a disposal of your Ethereum. And so that triggers a capital gains event on how much your Ethereum has gone up or down since you originally acquired it. There's other sides of challenges with NFTs is pricing the NFT, right? There's not a lot of really accurate pricing data for a lot of these things. So like you mentioned, if you get an airdrop of an NFT, or if you trade one NFT for another NFT, how do you assign fair market value to that asset? And that's a problem that the industry is facing. There's no shortage of issues when it comes to doing taxes on NFTs. Again, I would just always recommend people educate yourself on understanding where those taxable events are so that you can anticipate and not get caught unprepared once, the deadlines of the April 18th roll
All right,
around.
folks.